Today, we're going to take you through a template that we've developed for getting financing on certain types of earnout transactions. But they're generally usable anytime you're going to request a loan. And so the idea of these templates is to give you a tried, true, proven results getting format for requesting a loan that if you follow the format and use the template for guidance, you're going to find that getting that loan to finance your transaction is a whole lot easier. I'd like to bring your attention to that control panel on the right side of your screen, and I'd like you to notice that there's a section there called handouts. And there's a handout in there that I'd like you to specifically download. So this has a special format to it. It's designed to ultimately go to a lender to get their interest. It's not designed to sell them on the final loan making. And it's also designed so that it's something that you can send to a loan broker or many loan brokers or investment bankers for that matter, who are the potential source of your financing, or they are your access to the source of the financing. So when you see in the highlight area there, contact, and you see your name, phone number, email address, if you're sending this to a broker, I put their name and phone number and address in there because they will be sending this out to sources that they believe are the right source to finance your particular project. And I come from the world that says if I want somebody to help me with something, I make it as easy for them to be helpful as I possibly can, because results tends to follow a path of least resistance. So if a broker has got 20 deals that he's got on his desk that he's trying to work with, and you provide him with a document like you're going to see here, you go right to the top of the pile because he doesn't have to do anything. All he has to do, because you'll have his name already in there, is he has to copy this and literally send it out to 1 or 10 or who knows how many sources that he feels are right for your deal. Now, anywhere where you see the highlighted in yellow, those are the places that you're going to want to change, and you change them by doing a find and replace. So for example, you would type into your find and replace purchase company's name. So the company you're going to want to purchase, it's their name that would go in there. Now, every place in this document that purchased company name appears, and it appears frequently, that'll be replaced all the way through the document. So it's replace all. Where we create an SPE, a special purpose entity, to purchase the company, the name of that SPE goes in there, and again, it's find and replace, and anywhere in this document that appears, those will be replaced. Now, the agreement is divided into several parts. And again, the world likes the path of least resistance. They like the easiest way possible to know what a project is and to know what it involves and to make a decision quickly. And if you present it in the format that you're going to see here, you're going to get their attention right away. Now, all of the bold categories that you're seeing down that left-hand side, you're going to leave those exactly the way they are. But you are going to want to change for your particular transaction what that category heading calls for. We've left these in here because this comes from an actual transaction that we did. So it makes it easy for you to have this as a model where you simply replace our data with your data, but you keep the headings the same because this is what will be important to the lender to know, and know quickly without spending a lot of their time. So I'm going to go through this with you so you can see how it actually plays out. So in this transaction highlights, we start with company, let's call 12 trailing months TTM EBITDA. So what does this company put out in the way of annual cash flow? Well, last year, or the 12 trailing months right up to the month that this document was prepared, this company had an EBITDA of $4,680,000. So obviously that data has to get replaced with your company, the one that you're buying. The agreed upon purchase price in our letter of intent was $12,174,000, which came to 2.6 times EBITDA. So now the lender has a good idea of what are you paying for this company relative to the cash flow that it produces. We're asking for a loan amount of $14 million. And to help the lender understand why $14 million when there's a purchase price of $12,174,000. So we're asking the lender to loan us more than the purchase price. And part of the reason is we're going to ask them to also cover all of the transaction costs for actually conducting the acquisition, from due diligence to lawyers' bills to broker fees for the loan broker, everything. You'll see it when we get there. Then the next item we cover is interest rate, 14% per annum. That's a very healthy interest rate on a loan this size, very healthy. If we were doing this with bank financing, we'd be looking to do this at 8 or 9% at the most right now, even in today's money markets. Why are we willing to pay 14%? Because this loan has some risk factors to it that if I'm the lender, I want to know that I've got some extra premium income in here from the interest rate to cover any risk factors that I feel are above the norm. The preferred terms, we're asking them to loan us the money for 48 months, where we're going to fully amortize that loan over the 48 months. So we're going to pay that loan back with 48 payments of principal and interest, and those monthly payments are going to amount to $382,571. What I'd like you to see here is we're going to be doing a lot of homework so that the lender doesn't have to, that they can just literally read our numbers, put it into their formulas, and they know very quickly if this is a deal that works for them. So that's our preferred terms. However, underneath that, it says amortization. And as you'll see, the full amortization of that $14 million loan is possible in 36 months. And to see that, they see the Exhibit C, which is the pro forma, which shows the projected income of the company, the projected EBITDA of the company, the projected payments for the loan that we're asking them to make. And we show it to them what happens to our cash flows and our cash accumulations if it's done over 48 months and if it's done over 36 months. Obviously, we prefer to have the deal to where we can keep more of our own cash flow, and we prefer to pay it back over 48 months. But some lenders on a loan of the type we're asking for are not going to be comfortable waiting for 48 months to get their money. They want to compress it into a shorter period of time. And you can't see it yet, but we will when I get to. This company has a moderate amount of assets relative to the loan amount. So they're not going to get their money back if they had to liquidate this loan by getting the collateral and selling it. So that's part of where their risk comes in, is the amount of collateral here isn't representative of the amount of income and cash flow. This is a high cash flow business with not a lot of assets, relatively speaking. So that pro forma is very important, because if the lender can get his money back quicker and be fully repaid in 36 months, that in itself reduces their risk, because the faster they get paid back, the less chance there's something negative that can happen to the cash flow. The next item here that we cover so that they understand what's involved is security. And we attach a balance sheet to this, which you'll see when we get to the other exhibits. Balance sheet assets with no liens valued at $1,966,663. So the assets of the company are almost $2 million, and they have no liens against that. Lenders love to see this, because what it does mean is that whatever collateral value there is to them, they don't have to worry about anybody else in front of them that gets paid before they do. They know that the full amount of the values of those assets will be available to them should there be a need for a secondary source of repayment, because the cash flow for some reason didn't materialize at the level we all anticipated. The next item that's going to be important to them is management and key talent. And the key words there are they remain unchanged. When we negotiate our deals with the sellers, we don't do deals where the seller's going to leave in 3 months. We want them there minimum of a year. And we're not even really comfortable with that. We do most of our deals where the seller's going to stay on for at least 3 to 5 years, sometimes 7 years. And the idea is that that leaves us a long period of time to have a person running the business who has proven already that they know how to grow the business. And just from our conversational standpoint, we're going to want to make sure that they have a residual interest in the business during that period of time, that they're as motivated in the future as they were in the past to produce profits in the business. So this is important. Management's going to remain unchanged. The seller investment in acquiring company is another thing that's important too, because we're going to show the lender that the seller thinks enough of this company that not only are they going to stay on, but they're going to invest $1 million, which is going to come out of their sales proceeds, back into the buying company for 20% ownership. So the management stays on. They invest $1 million back in the business, which you don't do unless you're pretty comfortable that that investment is going to give you a return. And they then own 20% of the interest, which supplies a motivated seller to continue on making the business profitable. The next item that is important here is the purchaser. Who is the purchaser? They want to know that. Who's buying this thing? In other words, who are they going to loan the money to? And we're going to give them the name of the SPE. And this is important, a corporation with no distributions to shareholders. What's the difference? A lot of times when people do the SPE, they do it as an LLC. And what that means is that it's a pass-through to the buyers. So as that company makes money, there is a high incentive to just pass the money through to the folks who own the SPE. Well, lenders don't really like that. Why? Because they see any money being distributed to the buyers as money that's now taken out of the buyer in order to pay owners instead of repay debt. The lenders are going to be very selfish here, and rightfully so. They want to know any money coming into that company isn't going to get distributed to the owners. It's going to get distributed to paying down the debt. And when you use a corporation and you do it where there's an agreement that the funds stay in the corporation, at least until the debt is paid down to a certain period, lenders are going to feel very, very comfortable with that relative to an LLC pass-through. The next thing that's important here is the lender payment priority. We want the lender to know, because we stated here, lender is in first position. So that does give them the collateral value of the assets of the company. All assets owned free and clear. It's important enough that even though we stated above that the assets have no liens on them, we state it again here because we want to make it emphatic, because we want them to be clear that there are no liens. All right, income stability. Now, remember I said this was a risk company because it's strictly cash flow that comes in. However, there's a couple of unique factors to this particular company that we want to make clear to the lender. And that comes under income stability. And what provides that is that all of the sales of the company that we're buying are based on 2-year contracts with clients and patented technology that protect and stabilize future income. So first of all, this company has patents that these folks can't get this service elsewhere, not at the level they get it here. And the second thing is that they have a 2-year contract, so that once people sign on that 2-year contract, that income is stabilized over the 2 years. And since all of their business is done on these 2-year contracts, it means that under the worst of scenarios, in other words, they don't do any new business for the next couple of years, they just serve out these contracts and run out the contracts, then they're going to be able to substantially repay that debt, which does also mitigate the risk to the lenders. If there were no contracts and everybody could just cancel and take their business elsewhere because they didn't have this patented technology, then the risk factor in the loan to this company would be much higher than it really is. So these are all the factors that we're trying to put in front of the lender. Strategic growth. Okay, what are we going to do to this company, and what's inherent in the company that we can anticipate growth as opposed to a decrease in revenue or even a flat revenue into the future? And our focus is going to be on integration of vertical acquisitions and on bundling of services for scalable growth. Now, that's not a long enough description that our lender's probably going to know what that means, but they're going to ask us a question about it because there's the inference there that it's a meaningful growth strategy that we have. And what focus on integration of vertical acquisition means is this company provides a certain level of services. And we're going to acquire in the same buying company other companies that are vertical to this particular company. In other words, this company provides a certain service, but there are things that this company needs in order to provide those services. And then there are things that this company can do with other services that will help it better serve its clientele. So there's a synergy that's going to happen when we make these other acquisitions. And one of the things that this lender is going to see is that we will be making and are capable of making a lot of acquisitions that are going to enhance the profitability of this buying company. Now, the unbundling of services for scalable growth. This company right now on these contracts provides a bundle of services. That's why the 3 patents come into play. Each patent is for a different service that they perform, that when you put them all together, require custom work that has a high cost when the sales are first made. But after 2 or 3 months, the company has virtually no cost. It's all automated. Everything they do is automated, so that the cost to them is the first 2 or 3 months that the company is contracted. Then after that, it's almost 2 years of clear profit. So we want the lender to understand that, and we'll be explaining it to them in the document you're going to see here. But the unbundling of services, when we reviewed the services of that company, it became abundantly clear that if instead of putting all this work up front to customize this array of services, that these are services that could be offered unbundled one at a time with no custom work, sold as a product, so that the buyer literally could install it themselves, do it themselves, and work it completely themselves for that one solution that that unbundled service provides, with that patent. So what that does is it makes this business scalable. If you have to do custom work, you need some talented people that work at the front end of a new client to get them on board and to structure their solutions because of the nature of the organization of all the different components. But once you separate it out and market it just as a single solution for a single need, where there's no upfront cost to doing it, no high talented labor required to do it, now you've got a scalable business, right? Because as many of these as you sell, your service component of what you do is very, very small. And the amount of training that people need to do that part is very, very low. And their skill level and their competency level is nowhere near what it has to be if you're doing the customizing on the front end. So what this does is it makes this company eminently more profitable, eminently faster growing, eminently scalable, which if I'm a lender, that makes me really happy. Profit margins. High profitability driven by innovative technology and disruptive business model. So we'll show this as we get into the actual executive summary. We'll describe all of this. But in the meantime, they understand here that one of the features of this company is we're not just talking about a 10% profitability as a margin. This company has actually, and we probably should have stated it here, an 80% profit margin. So once those first 3 months are done, company has almost no expenses going forward. They're very, very limited. And so it's virtually all profit after the first months of customization. The expansion potential, the opportunity to expand into new markets and increase revenue through acquisition and productization of unbundled services. So this is what I was referring to before, because this is the real potential of this particular company, is the productization of those unbundled services can really make a huge difference in this company's earning capacity and how quickly it can grow. All right, so what you've experienced here so far is, as you can see, a very compact beginning of this process with bullets and bolding of the salient elements that if I'm a lender and I know just what we've seen so far, this company as a loan client has my interest. Okay, it has my interest as long as this is a loan in the area that I make loans. In other words, if it's the kind of lending that I do. So again, hopefully you see the nature of that particular section. All right, now we get into more of the text of this particular template. And so now we're going to start explaining what the lender needs to know, where the explanation is going to be longer, but now that we've got their attention, the chances are that they'll be inclined to read and do more work to understand the company, because they already know whether they like this company or not. They're not going to be wasting their time if they are going on beyond that point. So the next thing we're going to do is we're going to explain to them the acquisition structure of the transaction, because that's what they're financing. So now they want to know, well, how is this deal structured? All right, now remember, everywhere where you see yellow, it means that that is all being changed by the first time that you come to it. You do a find and replace, and you put that into the find and replace with the actual data that actually should be there. And then from then on, it's going to replace it all the way through the document. So every one of these, you only have to find and replace once. And after that, it ripples through the entire agreement, saving you time. All right, so the name of the purchaser, okay, the purchaser, name of the SPE goes there. You'll already have that because we had it earlier, so this is not a place that you'll have to replace it. I'm only going to say that this time because now, hopefully you understand the nature of how the document's laid out. A state corporation, so you would put the state in there, Delaware, Wyoming, New York, whatever the state is that we're incorporating that SPE, is a special purpose entity formed. Oh, and by the way, special purpose entity. You wouldn't know this if I didn't tell you, but the very fact that you have structured the acquisition to use an SPE already puts you at a professional level of respect by the lender, that without the use of that that they'll read here and see here, you wouldn't have. Every sophisticated buyer buys through an SPE. Unsophisticated buyers buy through the corporation that they already own, or if they're an individual buyer buying their first company, they'll be buying it personally. They'll be the stockholder of the new company that's being purchased. So the idea is that they'll be doing it directly. SPEs are done by sophisticated buyers to isolate their risk so that if anything happens, it's contained within that SPE. It will not affect them personally, and it will not affect other companies that they may own. Now, why is this important? You've probably gone to lenders, and no matter how much money you wanted to borrow, the question comes up of signing personal guarantees. I don't sign personal guarantees ever. Don't do it. And when I show them how I'm going to structure the acquisition and the sophistication of the structure, they know not even to ask me to sign a personal guarantee. And the chances of you being even asked to sign a personal guarantee when you're structuring the loan this way, and when you're asking for a loan $5 million or bigger, and the bigger the loan that you're requesting, the less chance there is that anybody's going to ask you for a personal guarantee. That's why I like doing bigger deals, because nobody personally guarantees big deals. It just doesn't happen. So you're in a very safe spot by the structure you use and by the size of the deal you're doing. So we're going to use a special purpose entity formed specifically for the purchase of, and then the name of that company, which we already have from up above, whatever state we're in, limited life company, DBA. Well, that phrase can be eliminated if the company just does business only in its own name. But if they do business through a DBA, then that's where that goes. This is an entity purchase, okay? We're not buying assets. So if we were doing an asset purchase, it would say this is an asset purchase, but we almost never do asset purchases, never. And the reason for it is this company has credit relationships in order to do business. They have people that they buy from and do business with. When you acquire the assets, you don't acquire the credit relationship of that company to its suppliers. So then you have to reapply to all the suppliers. You have to reapply for any licenses that they have. It's a nightmare if this is a sophisticated operating business to purchase assets and then redo all that stuff. And then what if your suppliers want to treat you as a new client? They don't want to give you 90 days or 60 days to pay your bill. They want you to pay cash up front. Well, now you got to have more money to buy the company because you got to continue business and you've got to be paying for your purchases up front. You don't want to do that. So we do entity purchases so that we don't have to reapply for all that stuff. The licenses stay in place, the agreements stay in place, everything that enables that company to do business stays in place. So it would be very rare that we would do an asset purchase. The only time we do an asset purchase, if we already own a company in that field and our buying company is part of a company that we already own that's in that field, then we consider doing asset purchases because we'll purchase the assets and deploy them in a company that we already have in that field, that already has the credit relationships, that already has the licenses, that already has all that stuff. So unless you own a company that's already well established in the field, you do an entity purchase. Upon completion of the purchase transaction, seller's name, the person who's selling us the company, the owner of 100% of the percentages of the purchase company's name goes in there. Now it's an LLC, so that's why you see 100% of percentages instead of 100% of the stock. Will own 20% of the SPE, and National Diversified Funding Corporation, which is us. So if you're doing this for yourself, that would be your company that's going to set up the SPE, will own 80%. All profits of the purchase company will flow through to name of the SPE, which will be the borrower of the purchase loan and responsible for loan payments. So that tells the lender exactly how you're structuring the deal. The 12 trailing months EBITDA of the purchase company is approximately $4,680,000. Neither the SPE nor the purchased company will have any debt that carries over post-close. So there's no debt coming with the company. It'll all be paid off, whatever little debt there may be. The only debts of the SPE post-close will be the $14 million purchase loan and conditional note to the seller, which is only paid from EBITDA in excess of the purchase company's current $4,680,000 TTM. So what we're saying is we are going to have a conditional note to the seller, but the only way the seller gets paid anything on the note is from profits over and above the $4,680,000. So that $4,680,000 first profit is dedicated to the repayment of the loan. Nothing can go to the seller in terms of any additional payments, which there's going to be milestones that they have to hit. That's going to be the conditions that are within that note. Excuse me. So that's again telling the lender that their EBITDA that's required to repay their loan is going to be protected, and that nothing goes out to the seller other than their upfront money that they get, their cash at close, until the payments are made on the loan. The requested terms of the $14 million loan are 14% per annum interest, with principal and interest payable in 48 equal installments of $382,000 per month, or $4,590,000 per year. These payments can be made from the company's existing EBITDA. So again, we kind of lock that up so that it becomes clear. And if it isn't clear, we'll get questions and then make it clear in our answers to the questions. The purchase company's balance sheet will include the assets of the company required for the current business operations, which are sufficient to accommodate foreseeable growth. So the company's got all the assets it needs to grow. These assets include the office building, which adequately accommodates the company's current personnel with some room for growth. The equipment is state of the art. You'd have to see their equipment for this place. It was mind boggling. You felt you went into a futuristic computer science company because they had the latest and greatest, which they could afford from their profitability in order to make the time of their key personnel as super efficient as they possibly could, supporting their operations. And then this is interesting. This particular company had some very expensive vehicles, but they used them for business in a very effective way. The vehicles, while they may seem ultra high-end, one was a Rolls Royce, and the vans that they used to transport people around were high-end Mercedes vans, are a key part of their sales capability. The high-tech, successful image presented to potential clients from the time they are picked up at the airport to their experience of the purchase company's high technology facilities contributes to the high closing rate, where the surrounding accoutrements of success become contagious. While the company has servers on site for developmental purposes, the client's systems are provided by major suppliers such as Amazon to satisfy their high volume and scaling needs, along with required redundancies. So what we're again telling them here is this company, as they'll see when they get into even the more due diligence documents, this company closes 92% of the people that come to their facility as part of they're making a decision as to whether or not to sign a 2-year contract with this company. And the 92% is outrageously high. And it's outrageously high because these people just blow them away from the time they get into the door with what they're going to do for them, how they're going to do it, and the physical accoutrements that says that these people are incredibly successful at doing this. Very important part of the selling process for them. Attached is a balance sheet that shows the tangible assets post-close. The company also owns 3 U.S. patents that are used to produce the company's high EBITDA. These patents, along with the technical and critical thinking skills of the staff, are the secret sauce behind the company's high profit margins. So at this point, this lender now has a pretty good idea of this company and how it's structured, and it's starting to build confidence in that lender that this is a real company with real profit-making capability, able to repay the loan that they're going to be asked to make. Then we bring that out even further in the next segment, which is the business model. A lot of times people don't pay attention to this, but what you really want to sell to a lender is how you make your money and how the company produces its profit and why that profit is going to be stable into the future. And the way in which you describe that business model and how the company actually produces its income is a very significant part of selling the lender. So again, the purchase company compares itself to an incubator, signing marketing contracts with nascent e-commerce companies or established e-commerce companies whose marketing is below par. So what do? They do marketing, in effect, for companies that are new in the e-commerce field or sophisticated in the e-commerce field, but where their margins or their sales are below par. The company's staff and outsourced providers provide an entire e-commerce platform and system to boost the client's sales and reduce operating costs, optimizing profits. Okay? Then we don't want to give you the secret sauce to how this company does this. So what went in here was a description of the company's business model, chapter and verse, how they earn their money and what their secret sauce is and what they do and how they do it. Okay, you got 3 strategic growth strategies. Here's how we're going to build the sales of this company. Vertical acquisition and integration. Now, we referenced this in the early part on the bullet points, but now we're going to get into it in more detail. The first is acquisition and integration of vertical companies that support e-commerce business. NDFC's role, that's our role as a buyer, ultimate buyer, is to acquire a portfolio of companies for that SPE that can benefit from the sales driven by the company that we're buying, or which can drive sales for the purchasing company. So everything's about strategic aggregation. You've heard me say that term many, many times. I don't say it, the term here, but that's what this is. We're going to strategically aggregate the acquisitions so that every acquisition produces more clients for the other acquisitions, including this first one that we're making. They produce more sales. These companies include credit card processors, a small bank, a fulfillment company. Now, why would we want to buy a small bank? Well, because this company controls the flow of credit card processing for all of its clients. It can direct, because it controls it through its own automated systems, they can control how much of that company's business goes to the credit cards that are provided by banks. Okay. Now, the reason that this is important is because right now they have to go through a bank for their processing. That bank makes more money on them than they make. That's the nature of banking. So we were going to want to buy a small bank and run it through our own bank with direct access to the Federal Reserve so that we borrow at the Fed rate instead of from a bank at the bank rate. Okay, so the amount of money that we would make on these transactions would virtually double. Now, we can buy a small bank not for tens or hundreds of millions of dollars. We can buy a bank for between $3.5 and $5.5 million that's already a functioning bank in a small regional area that's already making money, has a staff, has all that stuff that we need to process everything. And we can do it with almost all leveraged funds using the same type of transaction that we're using here. So we want to get our own credit card processor because they make a big piece of change on these people's end results. We want to get a small bank and a fulfillment company so that when these e-commerce companies are selling what they sell, rather than have them use outside fulfillment companies, we want them using our own. Okay, because again, these are all places that additional profit are hiding because this company that we're buying controls the process by how and where the processing is done, the banks that would be used, the fulfillment companies that would be used, and the processors that would be used. So we can direct that business to our own companies instead of having it go to outside companies. Low sales volume versions of these companies can be bought at bargain prices and quickly upgraded to high sales, high margin, profitable entities because of the traffic that we can drive to them. So we could take companies we can buy at a bargain and we can make them very profitable companies instantly because these folks control the flow. Okay, client acquisition, build up, and sale for high profit multiples. All right, this requires a little bit of explanation, but it's a way in which we will be generating profits with this company. The second strategy, okay, we already have the first strategy for growth, just covered that. The second strategy involves purchasing clients instead of merely contracting with them. Why is this important? Well, you're going to see. Enhancing their sales and profits and then selling them within a year for 6 times or more their annual EBITDA. Okay, do you know why all of these clients come to this company to up their sales? Is they all want to build up the company as quickly as they can and then sell it at a multiple of earnings to a buyer who wants to have that particular type of company under its umbrella that's earning those high profits. That's why they come to this company. So if we're doing that for companies so that they can sell their company, why don't we buy the company, do it for the company, and we sell the company for 6 times or more the annual EBITDA? Now, why is that a great way to leverage up your earnings? Well, by owning the client companies, our purchasing company reduces the revenue share from 50% to 5 or 6%. Okay, this may not be worded quite properly because let me just read it and I'll get back to explain it. Effectively doubling the client's earnings. Oh, now I know what this was. Okay, so right now the client pays our guys 50%. In addition to their fixed fee a month, they pay 50% of their profit to this company, which is why it's so profitable. They pay it to this company and it shows on this company's earnings, but their earnings are reduced. So when they go to sell their company for 6 times the earnings, they're selling it with only half the earnings that they produce for them. Well, what we would do is bring it down from 50% discharge to this client company, because we own it now, to only 5 or 6%, which covers the cash flow needs of this particular company that we're buying. But it effectively is doubling the client's earnings, the company that they're doing the service for. When these enhanced earnings are sold at multiples, i.e. 6 times earnings, the purchased company, instead of getting 50% share of the revenue or of the profitable revenue, okay, they are actually getting 6 times, doubled the earnings, because remember, they were taking off 50%, but they kept 50%. So now they have 100%, but it's now times 6 times, significantly amplifying the profitability compared to a revenue share model. So at a revenue share model, all they were getting was 50% of the earnings, which is a lot. But now we leave it in the company instead. So we have all the revenue there in that company that we've acquired as a customer of this company. We then double the earnings of that company by now leaving almost all of the earnings in that company, and then we sell that within a year for 6 times earnings. Wow, that's leverage. Okay, that's not a profit model. That is a unbelievable expansion, logarithmic expansion of how this company makes money. Okay, instead of making money from its service to a client, it makes money by buying the company, doubling and tripling and quadrupling the profits of the company through its marketing capabilities, and then taking 6 times what it's now built it to and getting that as capital gains income for the sale of the business instead of as ordinary income for a fraction of that amount if they were a client. I mean, that's mind-boggling, mind-boggling. So now you're the lender and you start to understand this, because we're going to explain it to them. It gives them a whole different orientation of how they're going to get paid and the surety with which they're going to get repaid. All right, moving on. Modularization and productization of component services. Now, we already alluded to it before in the highlights of the transaction, but one of the most prolific growth strategies for this purchased company involves unbundling, which they never thought of before we came there, their various services for individual sale to the vast e-commerce community. This approach makes growth scalable by reducing the need for talented staff to customize unique service packages for each client. By selling these services as products to solve specific e-commerce challenges, companies can quickly address their most pressing issue, requiring only pre-recorded tutorials and training programs. So we can videotape all that. We can create the tutorials, and then once that is done, it's done. It's done. And so now the company can self-install. They can self-manage. It's no longer this orchestrated process of all these different components harmonized and working with each other. A company is coming to us for a solution to a specific issue that it has, that it's identified, and it's an easy sale, an easy purchase, low maintenance to us, and low maintenance to them too, actually. Okay, these products sold with an initial purchase price and an ongoing royalty based on the benefit that's been achieved by the user. That's part of the license or user fee. Okay, ongoing royalty or user fees convert buyers into continuous revenue sources with minimal support costs. Ironically, many product buyers will become custom clients as they recognize the power and value of the purchase company's superior technology. Okay, so we have in a few paragraphs here explained to the lender a sophisticated and comprehensive plan for radically building the growth of these companies. But what this also speaks to the lender is we're pretty bright folks. Okay, they're working with some really sophisticated, very bright folks, and it all makes sense. It's all hits the common sense button. So while we've been very innovative in our plan for the company, we're able to reduce it down to common sense. Why didn't somebody think of all this before? Why doesn't every company like this do this? Well, because they don't have our experience. They don't have our skill sets. But we bring that to this company, which is part of the reason, by the way, that the seller is willing to sell the company to us at a reasonable price, because we're going to give them on the 20% that they're going to own after they do their rollback investment. We're going to make their 20% worth more than the 100% of this company was worth at the time that they sold this to us. So they get a double bite at the apple. They get all this money up front, takes all that risk off the table for them. Then we work with them through this process to build up this company. They have a second win when they come out of their share of the company 3 to 5, 7 years down the road. In the meantime, they're going to get paid a lot of money along the way too, because we're going to bonus them as part of this deal too for them. Okay. Moving on here, with literally hundreds of thousands of various products sold on the internet with these types of high profit margins, the opportunities exist for our SPE, our buying company, to be a multi-billion-dollar corporation. This is incredible because once we productize this and we reduce it down to a selling issue only, no longer maintenance or installation or custom designing issues, it takes that hundreds of thousands of products that are delivered on the internet through all these e-commerce companies, and it makes all of them potential clients for this company, where right now that it wouldn't be true, maybe down to a fraction of that number. So this is the scope and the scale of what we're doing. Okay, growth projections and amortization of the seller's conditional note. Well, we're paying the seller more than 12 something million dollars for this company, right? But it's all tied to conditional increases in the sales of the company over the next 4 years, all right? So the current EBITDA is used to fully amortize the acquisition loan over a 4-year term. So how does the seller's conditional note get paid off? The seller's note gets paid off from EBITDA produced over and above the current EBITDA. This is demonstrated by the attached pro forma. The performance milestones are structured so that a high percentage of the EBITDA above $4,682,000 per year is paid to the seller for the 5 years following the closing date. So that purchase company has to grow 25% per year for the full principal amount of the seller's note to be paid. Given the growth strategy stated above, both NDFC and the seller, who continues to own 20% of the buying company, are highly motivated to accomplish this mutual win for all stakeholders in this transaction. In other words, there's so much profit to be gained here and so much value to be added to this company that the seller is going to be busting their butt to make this work. NDFC is going to be busting their butt to make this work, because we're not talking about just maybe $1 million or $2 million or $5 million of profit. The methods that we've laid out here are the roadmap to a billion-dollar company. And it's all done within the scope of the expertise of everybody that's in this company and in NDFC. So there's a high confidence factor that this is actually going to happen. All right, and then the conclusion is granting this $14 million loan to the buying company. The name of the SPE is going to be put in there. Remember, all this is being replaced by find and replace. This has all been done already. All right, for the acquisition of the purchase name company represents a secure and lucrative opportunity. The purchase company boasts a strong 12 trailing months EBITDA of 4.68 million. So that's where it starts, and it's going to get a lot bigger, a lot faster from there. A robust balance sheet. Well, it's robust in the sense that it's got all assets and no liabilities on it. It's not near as much as it's being loaned, but it's still a great balance sheet with real assets in a building and equipment, all of which are, great equipment, state of the art, well maintained, everything that you want to see on a balance sheet, with valuable assets and an innovative business model primed for scalable growth. The structured loan repayments are well supported by the company's existing EBITDA. That existing EBITDA with no growth can pay it off, ensuring reliable servicing of the debt. With unchanged management staying, and key talent staying, and the added investment from the seller. Okay, what's our added investment? The seller is going to take a part of what he's getting for a reasonable purchase price for this company, and he's going to be investing it back in the company. The stability and continuity of the company are guaranteed. The strategic growth potential through vertical integration and modularization of services further solidifies the company's trajectory towards becoming a multi-billion-dollar enterprise. The loan offers a first priority payment position to the lender, underscoring the security and profitability of the investment. So that's the whole thing. Now you'll also notice down in the footer here of the company, everywhere on every page, there's the name of your loan broker and their phone number. And why do we have this everywhere? You see it's on the bottom of every page. That's at the top of this page. Is we want the lender at the very moment that the buzzer goes off in their head that they like this company to know how to contact that broker and say, "Hey John, we're in. We'll send you a term sheet. It'll go out today." Okay, that's what we're looking to accomplish. We want to make sure they don't have to go too far, wherever they're making their decision, to know how to contact that broker. All right, now we get into the exhibits here that are part of the executive summary. And we've already alluded to them all, so you'll now just see them here. So a company balance sheet goes in here, and along with a little bit of explanation, then it talks about what happens to this balance sheet post-close. closed balance sheet will have additional cash in the amount of approximately $1,500,000 from the seller's investment in the SPE, an unused contingency reserve, and unspent closing costs. So in our use of funds, which you'll see in a moment, we had those things, contingency reserves and unspent closing costs, because we want to have more money available to us than we need to do this deal. Okay, that also shows the lender that you are a sophisticated buyer. You don't ask for exactly what you need. You ask for more than what you need. And the reason for that is things happen. And the only tragedy you will ever have in business is not losing money, it's running out of money, because the game stops when you run out of money. General Motors, when it went bankrupt, was losing money for a couple of decades, but it didn't go bankrupt until it ran out of money. When it ran out of money, they had no choice. But lenders kept loaning even though they were losing money because the company was still operating. But at some point, they stopped lending. The company ran out of money. And when it ran out of money, it hit the bankruptcy court. The company's 3 patents are owned by the company, but do not appear on the balance sheet. Okay, so it's an asset of the company. It has sale value. There are competitors to this company who would pay through the nose to get these patented softwares and things. Okay, but it's not on the balance sheet. All balance sheet values have been provided by the seller and are subject to verification by further due diligence. Okay, so that explains what this is, the balance sheet. Then also on here, we put a copy of the P&L for the 12 trailing months, and it gives them a sense of where the money came from, what the expenses were, all that stuff broken down on the P of L. Okay, and then on Exhibit B, it's use of funds. Well, here's how we're going to use the money. Remember, we're asking for $14 million, and $12,174,000 is going to go cash on close to the seller. So the seller is going to put a lot of good greenbacks in their bank, and it reduces their risk. But then remember, we give them that second bite at the apple. Deal structure, closing costs, and contingency reserve. So here's where the rest is going. All right, there is a loan broker on this deal. And by the way, whose name do you think went in here, right? Loan broker was a 2% fee for the amount of the $14 million. That's $280,000. We anticipated that the due diligence costs for the company could run as high as $200,000, more likely to run $100,000, but you never know what's going to come up. The company, the lender may want a quality of earnings report. They may want to have a statement or two audited. We don't know what they're going to ask for, so we give enough money in there to cover whatever it is they could ask for, and we obviously hope they ask for, or what's needed is a lot less. And then you've got legal and accounting. So just if there's any new statements that have to be done, you have agreements that run from the letter of intent to the actual definitive purchase agreement to the finance agreements with the lender. All of that is legal work, and the legal bills today aren't cheap. The people we use are sometimes $500 an hour for those things, and sometimes they're even more when you get into really sophisticated acquisitions. NDC acquisition team, well, we got to pay our own people. This deal didn't happen by accident. It happened because a lot of very dedicated people in our company put this together and structured it in the way that it would be attractive to all the parties. And so 2% of the total purchase price or 5% of the down payment, those numbers are equal. In other words, if you look at total 2% of the purchase price, if you look at 5% of the down payment, same number, okay, comes out to $608,700. So that's what we're going to pay our team. That's why they work so hard to do this and produce the great structure and strategy that you see here. And then 100,000 miscellaneous. We know from experience when you do these things come up. Travel, who knows how many trips we got to take to a lender, how many trips we have to take to the seller, how many trips we have to take with other people that we have to talk to. We don't know. And then in addition to that, we put in a contingency reserve. This is very high contingency reserve here. But we did that because we wanted to have the working capital in the company to make sure we can pay for all that growth stuff that we put in here. It costs money to do that stuff, and it's not going to happen just all by itself. So we wanted to have that money there and available to us. So the total deal structure and closing costs are $1,826,000, which is very high. Lender's going to look at that and say, that looks very high to me. And we're going to say, yes, it is. And then we're going to explain it just the way I explained it to you. So the total use of funds is the 14 million, and between what goes to the seller and then these other items is where it goes. And then so that the lender can sleep at night, we explain to them that any deal structure, closing costs, or contingency reserve not used here will be retained by the buying company for working capital and reserve for debt service payments to the lender. In other words, Mr. Lender, by having this extra capital in the company, you're going to be sure that come hell or high water, recession, bombs, threats, who knows what, you're going to get your money. And these payments, we've done everything we can to make sure that we never miss a beat. on a payment to you. Okay, so everything we try to focus it so the lender understands we know their business, we understand their need to win, we understand the risk they're taking, and we've done everything we know how to make sure that there's never a default, never a late payment, never anything but honoring our agreement to them. That's page 5. And then Exhibit C is the pro forma. We've done a pro forma year by year. Well, actually, we do it quarter by quarter by quarter. The first year, we do month by month by month. Year 2, we do quarter by quarter by quarter. And then year 3, quarter by quarter by quarter. Year 4, quarter by quarter by quarter for 5 years out. And the reason we don't go beyond 5 years is they're paid off in 4. And if they insist they got to be paid off in 3, then they're paid off in 3. So there's no point in going beyond year 5 because that's a year past when they're out of here. And all of that shows that paying them off is like a piece of cookie for this company to do right out of the cash flow that exists. But with growth, it's a fraction of the money that this company makes that's going to take to pay them off.